Back in 2012, when gas was costing most consumers over $4 a gallon, or 0.85 euros per liter, ExxonMobil reported a net income of almost $45 billion. At the time, that was the highest net income ever reported.
But then, in September of 2015, Apple reported an annual net income of over $53 billion, a new world and Olympic record.
Those are big numbers, and just what do they mean? When the business media reports on a company's performance, they always reference reported net income. Where does this number come from? Well, the income statement. What is this statement? What does it tell us? That's the topic of this video.
Now, those who set the accounting rules and those who research stock markets and resource allocation have determined that information about earnings and its components measured by accrual accounting generally provides a better indication of enterprise performance than information about current cash receipts and payments.
This is what the income statement does. It provides financial statement users with information about a company's earnings and its components.
The income statement tells us about a company's revenues, increases in assets or decreases in liabilities from a company doing what the company does day in and day out. For Microsoft, selling software and hardware is their major source of revenue. It's what they do every day. In fiscal 2016, revenue for Microsoft exceeded $85 billion.
The income statement also tells us about expenses. Expenses are decreases in assets or increases in liabilities from what a company does every day. Things like employee salaries, rent, insurance, the cost of inventory, stuff like that.
And companies tend to report expenses by types so that financial statement users can get at this components of income that we referred to earlier.
For example, Microsoft reports 4 different types of expenses. Cost of revenues, these are the actual cost of the Xboxes, the Surface tablets, and the like. Selling, general, and administrative expenses, things like research and development, sales and marketing costs, and other SG&A expenses. A category called Other for miscellaneous stuff, typically pretty small, and then income tax expenses.
Breaking expenses into categories results in the following components of income: gross margin, the difference between what a product costs us and what we sell it for; operating income, our gross margin less our regular and recurring expenses; income from continuing operations, that's operating income less net interest expense. Now note that Microsoft doesn't have this component since they don't borrow a whole lot of money. Another component is income before taxes, which is our operating income plus or minus our miscellaneous other income. And then finally, there's net income, which is income before taxes less our income tax expense for the period.
With these different components of income, we can start to analyze the company's performance.
Let's take a look at 2 companies we're familiar with, Walmart and Target. Since Walmart is so much bigger than Target, we have scaled each income statement by revenues so that we can compare the performance of the 2 companies.
First, notice that Target's gross margin as a percentage of revenues is much larger than Walmart's, to the tune of almost 4.5%. That's a lot of ground to make up.
Walmart's operating expenses are less than Target's as a percentage of revenues, 20.1% compared to 22%. So Walmart has closed the gap with Target a bit when it comes to operating income, with Walmart at 5% and Target at 7.5%.
Interest expense is slightly smaller as a percentage of revenues for Walmart, resulting in income from continued operations of 4.5% for Walmart and 6.7% for Target.
And because Walmart has lower income before taxes, it makes some sense that their taxes would be lower as a percentage of revenues. We see that Walmart's income tax expense as a percentage of revenues is 1.4% compared to 2.2% for Target.
The result is that Walmart's net income as a percentage of revenues is 3.1% compared to Target's at 4.5%. Walmart just wasn't able to make up the difference that began at the gross margin.
Now, hopefully you can start to get a sense that the components of income can tell us a lot about a company's performance. For Walmart, compared to Target, they certainly control their operating expenses, but their gross margin is significantly lower, resulting in a lower percentage net income.
Looking at these components of income over time gives us a glimpse into what a company can do to improve.